Good morning, everyone. This is Andrew Dakers at West London Business here in Chiswick, West London. Also in the webinar space, I'm delighted to welcome Simon from Vail Williams, who's going to be leading the delivery of today's webinar. I think we may be expecting one more attendee on the line. But we are going to press on nonetheless as we have struck 11 o'clock. Now, Simon, if you can move me forward one slide, I'm going to kick off just with a little bit of background on how GoToWebinar operates for anyone that's unfamiliar with this environment. First of all, just to highlight that you can click on the sort of plus icons next to audio and questions/chat, which will expand out the control panel and make it a little bit easier to use as the session progresses. If you can move me forward again, Simon. Other essentials: once you've opened out the control panel, you have a button that I've sort of circled in red that will expand out Simon's presentation into full screen view. Entirely your discretion as to whether you think that's makes for easier viewing or not. Just beneath that, we've circled in red the raise your hand icon, which you can use to grab the attention of Simon or myself as the webinar progresses. And perhaps most important, if you have questions of clarification during Simon's presentation, or indeed at the end, you'd rather use the chat box rather than the microphone to throw questions Simon's way, then that's a key place to click, type, and press enter for the message to send. At the moment, all participants and guests will all of your microphones are muted. At the very end of the webinar, or before the Q&A starts, I'll unmute your microphones so that you have the option of using your microphones to ask Simon any questions. Now, Simon, if I can ask you to give a quick hello.
Yep. Hi there, Simon Moffat here.
And if I can now ask you all to click on the raise your hands button, just to confirm that you've been hearing Simon and I. Okay. Fantastic. I've got 3 hands up. Natasha, Nikki, can you hear us? Okay. If you can click on the raise hands icon, brilliant. Let's see. That's pretty much a full house. So I'm now going to put your hands down so you can raise them again in due course as and when needed. So if you can move us forward a slide.
Oh, says he doesn't want to move. There we go. Don't know what's happened to the mouse. There we go.
Brilliant. Well, I'm sure you've all, in signing up, read Simon's background. Man of huge experience in this field, relatively new to the Vail Williams team, but hugely experienced both in a West London, London, and indeed national context. So we really couldn't have anyone better to guide us through the changes ahead in business rates this morning. So really, without further ado, time isn't on our side. I'm going to hand over to Simon to introduce the session.
Andrew, many thanks indeed, and welcome everybody. Thank you very much for attending today. I'm basically, as you can see, I'm the lead partner now at Vail Williams in relation to rating, and I've been doing business rates now for nearly 30 years, starting off with Edwin Hill and then running my own company for near on 20 years. The reality about rating is that obviously it covers a wide remit. We've got people today who are really occupiers and users. We've got people actually who are also involved in rates themselves within from the perspective of local authorities and districts, environments, etc. So trying to give a seminar that covers all areas is a difficult one because obviously there's a skill set differential between everybody. So the way I'm going to do this today is I'm going to give an overview really, and that's my objective, frankly, of this webinar, to talk about business rates from an operational point of view. It's not really meant to be a lecture on the mechanics. but more a screenshot of really what are the key issues. So the first part of this seminar really is going to be dealing with the issues of rating, as how it's perceived by people who have a working knowledge of it to a degree, but actually have an operational responsibility to it. And I suppose my objective really is just to take away a better working knowledge from a business rates perspective. Clearly, the second part of the lecture is probably going to be a lot more interesting to people who are dealing certainly with local authority issues. It really is what's changing for the next revaluation, because there is a lot. And I'm going to be sort of devoting 15 minutes really effectively to the first part of an operational overview of rates. Then the second 15 minutes will be regarding the 217 rating revaluation. So let's crack on. Here we have, business rates. Why do I feel like this? And this is very much from the operational point of view. Over the years that I've been doing this, a lot of rateable occupiers, tenants and landlords and freeholders have all said to me, God, this is such a confusing system. They run businesses, they understand their companies, they understand everything generally about their business, and the only bit they don't understand is how their rates are calculated. And there's a natural reaction really to flare up against the value that they're receiving for these services. And it's been, I would say, a good 50% of every time I go and talk to a rateable occupier, I'm explaining the system. I don't think they like it or believe it really, but it is one that has been sort of around for a very long period of time. And in a way, you come away from meetings thinking, well, have I really clarified the area? Are they any clearer on the position? And I think people are clearer on it, but I don't think they're satisfied. And it's one of those sort of situations, it's balled up into the feeling of a tax, and that's, first of all, bridling. And then secondly, it's sort of seen as an operational restraint against their business profitability. So it's quite a complicated environment really, because what we are here to do is obviously to look, we believe anyway, at the fairness and equity of rates. We totally concur that rates should be paid, and we totally want to assist in the collection of that in a roundabout way, and I know that sounds strange, but what we're trying to do primarily is ensure that the occupier or the rateable occupier doesn't pay any more rates than he needs to, and it's a fine balance. So in a way, what we have to do is try and sort of run through the first sort of question, which is rating, is it deliberately difficult? Well, I wonder. Well, let's consider it really first of all. The reality is, it's a tax. It's a tax, it's a local taxation, and it's a system of raising revenue year by year within a geographical area, mainly for the expenditure incurred by the local authority functions. But conceptually, it's, a tax on occupation, and this is so key to understand, and it's really what I think a lot of people say to me, well, why am I charged this? I'm not getting any services, and I have to say, well, I appreciate that's what you feel, but it's really not about that. It's about the fact that you're a rateable occupier, and it's a tax on occupation. And often the question that seems to be said to me, well, why are there two entities that, I don't use the word entities, but why are there two people that we're dealing with? We've got the VO, the Valuation Office Agency, and then we've got the council, and we know that's the charging authority or billing authority. Well, why? Why are there two people? And it's a really good question, actually. And what I've said is, well, actually, it's all to do with the way actually rates have developed since the 15th, 16th centuries, actually. And, it's a mildly interesting thing, which I will come on in a second to talk about. But in essence, there are two entities for very specific reasons. As you know, or you may not know, there's the Valuation Office Agency, which is a part of HMRC, and they generally are chartered surveyors, and they set the valuation. And in a roundabout terminology, they're really not interested in the rates that the rateable occupier, or tenant, or freeholder has to pay. And then there's the charging or billing authority, and they're a collection agency, and they're not interested in the valuation, simply in collecting the money. And I know that's brutal and a bit sort of simplistic, but I'm trying to give an overview here. So just concentrate on those two sort of points really. We've got two different organizations working under the one umbrella, but with two different roles. And the third thing, a lot of people say to me is that, go on to Bennett, there's a lot of terminology. There's rateable value, there's NNDR or UBR, there's transitional relief, there's exemption, empty rates charge, and lots more that are sitting on a demand that by way of explanation, actually, a lot of local authorities, building authorities, are very good, and as the VOA, at giving the explanations, but you've got to go and find them. And then probably they lead on to further questions because it doesn't really give the transparency that people want. It gives the factual evidence of what they are, but it doesn't really give a meaning to a lot of this. And I think that is a fair criticism of what is a taxation. And going back to point one, well, it is a tax. And I'm afraid to say there isn't any way getting around it. Tax is taxing sometimes, and it's a problem. And so I've always tried to sort of make it as open and transparent from my perspective, really, to them, without going into much of the detail, which sounds simplistic, but it probably is right, because I think a lot of people aren't interested in the minutiae. They just want to understand as an overview. So let's trot briskly through the history of rates. I think this is important because it really feeds back to why there are basically two entities: the Valuation Office Agency, the Billing Authority. So rates can be traced back to the 11th century, actually. Its earliest period, it was actually all commensurate with the Poor Relief Act of 1601, and it was also called the Statute of Elizabeth. And its point was to levy a local tax on every parish throughout the country. Now, parishes were actually the only unit-wide unit of local administration in the country, and it was really due to the dissolution of the monasteries that created this state of affairs. Roman rule having dissipated in about the sort of 5th century, the only organizations that had land and control based on the Roman system was basically the ecclesiastical religious orders, obviously effectively the sole one. And clearly they were in control of a lot of land, and they created parishes' boundaries and administered them. And it was the natural reaction of Parliament in those days to actually say, well, effectively we've got to use some form of administration unit, and that's how it was created. In the 1601 Act, overseers were appointed the power to tax. And here's the key point. They made two classes of person rateable at that point. It was the occupier and the inhabitant. And then the second point is to calculate the tax. It became habitual to have regard to the value of the land and tithes, mines, forestry, houses, etc. And really under point 3, these twin concepts of value and occupation were the pillars that became the local taxation issue of today. So I know it sounds strange, but it all stems back from this particular point. And it really helps to explain why there are two entities that deal with rates. And you have to follow me on this. Firstly, the Valuation Office Agency still deals with values. And secondly, the charging authority are still charged with identifying the occupier for rating purposes. So that's where it all stems from. I mean, it's simplistic because there's been a lot of acts in between, which I'll talk briefly on in a second. But the reason these two entities were created was to obtain uniformity of assessment across the whole country. So that's the key point, uniformity of assessment. And that's, I think, what this tax really says. So where are we at today? Well, a lot has changed. Oops, sorry, go back. Yeah. The current rates are actually governed by the Government Finance 88 Act, but we're going to talk generally first of all about the 1967 Act, which is called the General Rate Act, which is the consolidation of all earlier statutes. Its provisions were made in force for 23 years until 1990. Other various acts and regulations entered on statute. And things like the Rating and Caravan Sites Act 1976, the Rating Charity Shops Act 1976, and really snappily entitled one, Exemption of Unoccupied Industrial and Storage Hereditaments Regulations 1985, which interestingly suspended local authorities' power to levy rates on empty warehouses. So it's been around before that one. But in essence, that was swept away by the important and current Act, which was the Government Finance Act of 1988, which set the modern day rating system. This was a radical change. As I say, there hadn't been a review, in fact, for 23 years since the last revaluation, so it was long overdue, and the 67 Act was, in all intents and purposes, repealed. And it was all changed. And new rateable values were effectively created from the 1st of April 1990, and you'll remember this one, or probably if you're older than me anyway, a community charge. poll tax was introduced, and enough said on that, and that died it out. And then one of the key areas to go was this thing called rate poundages, although that you'll still hear that talked about, and even I use it because I'm so old, but effectively, and what changed there was a uniform business rate was applied nationally, and that is what is really important. It was a uniform. So in other words, it covered all charging authorities and the entire English and Welsh parishes effectively under local authority control. And interesting things like transitional charges and release were introduced. And then I suppose the third point really of the main changes is that quinquennial 5-yearly evaluations have been introduced since 1990, and I say well except for this one, which actually is 7 years. But there subsequently have been revaluations every 5 years, 95, 2000, 2005 and 2010, although this, as I mentioned, now has been extended to 2017. And the reasons for this really, it was claimed would help occupiers to give stability because we hadn't had a revaluation since 1967 to 1990. So there were some really fundamental changes that occurred here, and that I think is really all I want to say primarily on sort of the situation of where we're at today, and let's concentrate really probably on the sort of more important things that we want to deal with now. There we go. And let's talk about the analysis of the sorts of data that you would look at from the perspective of if you were CFO, FD, and you're looking at how to try and get your head round rates. So we talked about two entities. We talked about the Valuation Office Agency, and we talked about charging authorities. So here I just want to point out to you, and I hope you can see my mouse moving around on the screen. In essence, we've got what's called a summary valuation. Now this is available, and this is a 210 rating list assessment, and this is available on the VOA websites, and there's a link there to actually the site where you can go and assess your rateable values. Now the reason I put this up is just to show you what is published documentation that actually describes the property. I'm just going to run through the various sections of the important bits. First of all, the address of the property, which obviously is self-evident, and importantly a postcode. Now interestingly, the Valuation Office Agency don't operate the same postcode always as the Royal Bail, and it causes an awful lot of problems. Clients often say you got your postcode wrong, and what actually happens is when you go online, you will not be able to find your premises if you search by postcode if it's not the same postcode that the VO uses. So it's just, that's it. I can't explain any reasons why it is, and it's a thing that I've lived with for 30 years, and it's made our lives quite difficult sometimes to try and identify a property or a hereditament, as we call it. Now, the next bit shows the rating list 210, self-evident, so that makes sure you're talking the current rateable value. And this is an effective date. Now, I'm only going to dwell on this for a second or so. Generally, if it's a compiled list, i.e. start at the beginning of the list entry, it'll have 1st of April 2010. If there's been subsequent amendments, which there has been to this property, then the amended date is what's put here, and that relates to this valuation here. The next part really described is offices and premises. That's a descriptive nature of the premises, and it actually has a specifics category code, we call it, that actually relates to this particular property, and it ensures that there's uniformity, that all assessments of this type and nature are included in the correct mode and category of occupation, we call it. This is again done by the VO. And here we have the billing authority. There is an interchangeable name, charging authority, billing authority. I think everybody understands it as the council. So that's the people who are collecting the rates. Now this is an important bit. This is a unique number. This relates to the actual property itself, and it's always worthwhile noting because that actually is the only unique thing that's really specific to this valuation. Don't particularly worry about the category code here. And the base of management, which is net internal area, these are more surveying issues, and importantly, this is something that's quite relevant. If you click on this, you can actually see other valuations actually that are similar to yours, and that's an important tip. So if you want to look at the scheme reference and find other properties that are valued at the same rate, then there we go, that's the button to press. And here we have the unadjusted rate per metre squared. Now it's all in per metre squared, not feet, so effectively everything is by a factor of 10.764 effectively, but in essence, if you're used to working in feet, you have to divide and get this down to a square foot analysis, but we don't, we work in metres. And so the areas here are all in metres. And here you can see there's some sort of differentiation. Effectively, you think, well, why is the 650 not the same as the 624? Well, there's been allowances granted here, which you won't know why, and this is part of the confusion issue that a lot of people say, well, why isn't the figure there showing here? And often it's the other way around. There's an unadjusted figure, and then they've got an increased figure here, and that's the point. It's unadjusted. The Valuation Office makes amendments to the rates per metre squared, and here you can see on the basement, it's halved. Because effectively the value for a basement is not perceived to be the same as ground and first floors. So here we've got an adjustment. The actual particular adjustment here is because of the air conditioning quality isn't the same as it should be in a comparable building. And here we've got all the areas. Now this is key to talk about this, because to the future in the next revaluation you're going to have an ability to go online, look at your valuation and consider whether or not your facts of occupation, which is what we call here really effectively, the areas, the address, the descriptor, the rate per metre squared is something I'll come on to in a second really, but the main fact you're going to be interesting is does it have everything in there? Does it have maybe another floor that you're not occupying, in which case that needs to be changed. Mistakes do happen. So in essence, this is now a calculation system really here of applying the unadjusted or the adjusted rate per metre squared to the areas to give a value. And the summation of those values comes to that, and then there's a bit of rounding, and that creates your rateable value. Now rateable value, and again I'm not really discussing too much about the mechanics of what is a rateable value, but what I explain here is an estimation, an annual estimation of the hypothetical tenancy effectively of a year-to-year tenancy with a reasonable expectation of continuance based on an FRI basis, assuming a rental basis of effectively the 1st of April 2008, an antecedent date. So this valuation is a rental valuation effectively in the past. It's not current. It's as at the 1st of April 2008. So that's an odd system, and it's not the rates you pay, because that will come on to a minute, that's on the demand. It's basically a valuation, and this is what the VO does. It values, it's objective, it's not to charge, it's not interested about the rates you pay, it's about what is the rateable value that is entered into the National Non-Domestic Rating List.
If I can interrupt very briefly, I see that Nikki has a hand up. Nikki, if I can, I'm going to try. I can't unmute you, unfortunately, because I think you're dialed in by phone. But if you're able to use the chat window, then you could type a question or query for Simon and I to pick up on. But whilst you do that, Simon, please continue.
Continue. Okay, fantastic. So now let's look at the second entity, as it were, and this is a rate demand that you'll probably be familiar with. I've chosen the city of Westminster here, and I'm sorry this is particularly poor quality, but it's just the way I'm afraid my technical skills are not that great. But here we go. What we've basically got is a rate demand, and it's very familiar, and it sets out various bits and pieces that would be sort of commensurate, and it's a document actually that's a legal document to a degree because it's a demand, and it's a formal request for payment right down there of a certain sum of money. Now, there are several factors that we need to be absolutely correct, because at the moment really if there's incorrect information on this demand in theory is invalid, albeit that the objective of the exercise is obviously to correct those errors and make it valid again, and that is the primary objective of the charging authority, and also the duty of care really to actually the ratepayer to make sure to a degree things are correct. You don't want to pay rates for anything you don't occupy, and you don't want to pay rates that are incorrectly summed as well or demanded. So the first thing that you need to check is actually that the address of the property does relate to you. So I've highlighted here, but make sure that is correct, and if it's not, well, that demand needs to go back or send notification. The next important really area is to look at the calculations of the liability, and I think the important thing to hear is to check is that you've got to first of all make sure that you've got the correct rate year. And what you're really looking at here is actually the charge has to be over a period of days. Why? Because rates are actually calculated on a daily rate. Unusual, but that's how it happens, because rates are a tax on occupation. If you don't occupy, then in effect you're not liable. So that's a simplistic terminology, but I want you to just concentrate on that for a second. The RV for the period, it relates to that period 1st of April 16 to 31st of March 17, is 535, which is back to here. So you can see, oops, sorry, that's where they get the rateable value from, and that is ascribed here. So the VO directs City of Westminster with the rateable value in the rating list, and they then create the liability. So the non-domestic debit is 535 times the non-domestic rate multiplier of 0.497. In this case, the reason they put 2 periods here, that if it was a leap year you would see that that would be by 366, and that actually gives you the total here of 265,000 to pay. And then effectively there's additional information here. There's a cross-rail supplement for those inside the M25. Unfortunately, with RVs above 50,000, you have 55,000, you have to pay, unfortunately, a cross-rail supplement. And in essence, I'm afraid that is points and pence in the pound. And again, people say, well, you know, why am I paying this? And I'm afraid to say that is just taxation. It's something that unfortunately you have to pay, and there is limited amounts of value. That I can explain it very simply by saying that we believe there'll be, in theory, betterment to the people within the M25 because of Crossrail and the value that that should bring, and therefore in a way the occupiers that are going to receive that value should contribute towards it. I think it gets a bit sort of difficult when you're perhaps outside of the M25 near Maidenhead and you don't have the Crossrail supplement, for example, and therefore then so it's not quite as straightforward as it sounds. Always check your rate demands. You immediately see here there's 2 line entries of 110,700 quid for the Crossrail. Effectively, it's just terminology. If you add these up, in fact, they are not calculated twice. But that doesn't mean to say charging authorities are part of the role of you wanting to check your demand is everything is mathematically correct. So that, in a way, is a dive through a demand, and in a way, the key elements which we'll come on to are things like the national non-domestic rate multiplier, and I don't want to go there, and the RV for the period. I think again, you know, what you'll see is that your liability is different from your RV, and that's a key point, self-evident to a lot of people I know, but that's that the reaction that a lot of people will have when the rateable value changes next year is, my God, my rates are going to go up. Well, yes, but it does depend upon what will be the national and domestic rating multiplier. At the moment, it's for larger properties anyway, it's 0.497, and for smaller properties, it's 0.484. What will happen next year, and I'll talk a bit more about this later, is that that rate, non-domestic rate multiplier, will change, and it may fall. I'm of a view that it won't, but people are putting a lot of work into this, and it's a comprehension issue that I'll come on to shortly. And it really is whether or not the number of properties, new properties that are entered into the rating list, and the total value of the rateable values, and the new rateable values divided by the number of properties, actually change. So what could happen is the actual values fall there, but the non-domestic rate multiplier, you might see your rateable value fall, but you might see your non-domestic rating multiplier increase. So it's a complicated issue here, and I say I'm not going to talk particularly at this point on it, so I'll come back to that in the future. So these are the 2 demands, bits of paperwork. You can find that in the public domain at the Valuation Office Agency. This is sent to you, disappointingly, in March every year, and it sets out what you've got to pay. So that sort of covers the first part, and I've overrun a bit, so I'm going to now carry on for really what's changing for the next rating list, which I think is really probably more interesting now from the point of view of the immediacy. Last Thursday, hot off the press came the reforming business rates of appeals. There was government's now finally confirmed that it's come back with its formal response to the consultation that was due to be in January, but in fact it arrives now only 6 months late. And this is important because it's now sort of confirmed that it's basically going to have a new 3-stage appeal process. Now, appeals are the bit I'm going to concentrate really, because this is the most important change. There are actually lots of changes that are occurring to rates, issues regarding reliefs and small business rates, and indeed there'll be changes to multipliers and all the rest of it. But I think the important thing from occupiers' points of view is what's changing to the appeal system, and how will it affect you and your rating advisors, really, because this is the important part that's now changing. We're going to have something called check, challenge and appeal. effectively, the government has decided really that there are three reasons to do this, and the DCLG are reforming business rates. Officially, it says there are too many appeals that take too long. Okay. The reality is actually the cost of the government, they say, is in the process expensive, and probably the reality is that the cost of the VOA is expensive to the government in having to prosecute these things. I totally get it from the local authorities' point of view, or charging or billing authorities. Repayment of overpaid rates does affect budgeting and affordability, as it were, from the point of view of what they can provide in the way of services. So they don't like slow, long rating processes that take many years, and certainly appeals have in the past taken over, if not 3 to 5 years, to conclude on very complicated or difficult or principled situations. And that, of course, means that the local authority have to repay overpaid rates out of reserves that they have to basically budget for, and causes all sorts of problems. We understand that. But I think the reality is, the actual reason is deliberately the government wants to limit appeals by making the process more costly for a start of, i.e. to the ratepayer, not to themselves. So they want to charge the ratepayers to appeal. They seriously need to hold on to tax, as you probably will be well aware the country isn't in a strong financial position, and this is evidenced by the fact that the government has limited the return of overpaid rates in accordance to certain legislation that's been enacted over the last 2 years. And of course everybody understandably wants to reduce the administrative burden or the costs on central government. So, you know, there are probably reasons why one may say the government is seeking to put change for the benefit of the ratepayer, but actually the cynic of me, and I've been doing this for so long, I realise that that's very unlikely. Reality is the ratepayer isn't really at the forefront here. What is maintaining the tax revenue and basically trying to stabilise this from the point of view of devolution, which is coming down the line in 2020 when local authorities will have the ability to set their rate parameters, their rateable non-domestic rate multipliers. So what is the process? Well, the first process is a check. This is stage 1, which is theoretically might commence actually when the draft list is published on the 30th of September. I'll come back to that point. And here there'll be an opportunity for you to look at the Valuation Office website and identify your new rateable value, and it'll be this summary valuation which you've seen before, and it will show you how the valuation is being compiled. Now the rates, as it were, the liability is not live yet. That doesn't happen to 1st of April 2017. So this is simply a draft list, but it will allow you, we think, just simply probably by petitioning the BO with the evidence of any inaccuracy on the physical factors, i.e. areas or items that are included in the valuation that shouldn't be, and get those rectified before the 1st of April 2017. So when the compiled list comes in, it's correct. So then officially the check stage will go live from the 1st of April 2017. And the government is planning now to allow verified ratepayers, we don't know what that quite means yet, and that's the ratepayer or it's the ratepayer's agent, or both, to log into an online account, and there they can check and validate the relevant facts held by the VOA. And as I say, it'll be about the property facts, and it'll also see how the valuation is compiled, and hopefully there'll be additional information, maybe rental evidence, how they based the valuation. There will be a declaration of sorts at this point, we think, that you've got to confirm that you've checked that your rateable value, as it were, is correct. Now, the reason for that is really changing the onus, we think, from the VOA to maintain a correct list and putting it now on firmly the shoulders of the ratepayer. Now, this is a very important element of the valuation process, which I think may cause concern, and I think where a lot of people will need to seek advice, because, you know, will you know whether your valuation, certainly from the point of view of the actual physical factors, are correct? Areas, for example, you may not have measured your premises. You may find that the mezzanine is included and there's a different method of valuation underneath the mezzanine, you know, and you won't know these things. So to check that and then make a declaration, it might be an interesting area. So, but we're still waiting information on this. I'm afraid to say the government hasn't actually finalised this yet. If you disagree with summary valuation, you've got to put forward an alternative. And the VA will respond within 3 months, that's suggested, but after 12 months, if nothing's happened, this converts immediately to a challenge, even if facts have not been agreed. So effectively the check phase seems to be very much something that's now going to be based upon the rating occupier and not the the Valuation Office Agency will obviously maintain the rating list is correct, but it's up to really the occupier to prove now very quickly if there are facts that he disputes with. If it really concerns valuation, that's fine, that can be challenged at that point, but it isn't really a formal challenge. It's not like an appeal, it's more still a negotiation. And after the 12 months, as I say, if nothing's happened and it hasn't had a resolution, then it goes to challenge stage. Now, at the challenge stage, this is really where formality will take over. I think the ratepayer and their agent will need to set out the grounds for the challenge, that is a definite. It will need to provide an alternative rating list entry. Now again, what that specifically means might be just a single figure, or it might be a summary valuation effectively. There may well be a reasonableness test here. In other words, unadvised independent ratepayers might have a lower level of proof to provide to the VO, whereas people like me will have to give a formal statement of case, prove all my evidence, show that evidence, give all the comparables, and submit it as a formal document like a written submission. But anyway, whatever happens, the evidence has got to be provided to the VO and a statement explaining why that evidence supports the proposed rating list entry. Now, if you haven't basically confirmed your details and looked at the situation, the challenge stage, it said it was originally for 12 months, but in fact, at this point, if the facts are okay, can last up to a period of 18 months. Now, that's the current situation. Now, obviously, they don't anticipate it to be 18 months, but that's a heck of a long time. And given the way the current system operates and the lack of personnel within the environment of the VOA, it has been a problem to get appeals dealt with. So we watch this space. But at one point in the challenge phase, the VOA is supposed to issue a decision letter setting out the decision with reasons. And at that point, the challenge stage ends. And then you've got a decision. You've got 4 months from that point to formally appeal, if you wish, to the VTE. And again, there's protection issues here that if after 18 months no decision is forthcoming from the VOA, the challenge moves to appeal automatically. And then there's even a further sort of caveat that the ratepayer may grant an extension beyond 18 months if they wish. So, I mean, the challenge phase could go on for quite some period of time. So what really this all means is that if we get to the point that we go to an appeal, there is slightly a sting in the tail as well, that effectively if you want to appeal it, you've got to pay for it. Up to now, all appeals at the Valuation Tribunal effectively, the costs of which have been borne by the taxpayer, not by the appellant or the respondent. So what the government is doing now is trying to limit what they think are speculative appeals by this process, and secondly, by actually making a punitive charge. This charge would be refunded if the appeal is successful. It will be a maximum cost of £300 to appeal per appeal. So I'm not saying it's stuck at 300 quid, but I think it will be dependent upon the size of the business, and that criteria is given in the consultation document about that. But for all intents and purposes, for most occupations with a turnover under 6 million, effectively, that is the level of value or below you're going to be paying. So effectively the check stage, so the draft list and the rate of value will be listed online from the 3rd of September. Here you can go and look. Within the 1st of April 2017, you can agree your summary online valuations are correct with the VOA, and you agree the facts of occupation. And if you do that, and you still aren't happy because of the value, not the facts, but the value are wrong, you can instigate a challenge. Or if you disagree with the summary valuation, you put forward your reasons at the check stage, and the VA will respond with 3 months, but after 12 months, either way, it converts to a challenge. Keep it up so far? So effectively, we have to set out the grounds for the challenge, provide an alternative rating valuation, provide evidence to the VO, and the challenge can last up to 18 months. And after 18 months, the challenge moves to an appeal, and then full disclosure is required and a maximum fee of £300. My goodness me, has this created a simpler system or not? It hasn't. I mean, this is now going to be a very time-consuming and complicated environment, I'm afraid. It should work easily enough, but I think what's going to happen is it's just that the timescales can be quite long and may be very long in certain circumstances where there are principles at stake. and we've seen principles on rating appeals go forward and take very long periods of time. What are simplistic and should be straightforward agreed aren't. And I'm afraid this is where the problem may lie, and I'm very concerned about this process as being overly complicated from the perspective of the ratepayer and not one that's actually becoming simpler. We as advisors will be able to get a head around it and advise, but I just feel that yet again what was the opportunity of making things much more simple has actually really created a system that's just prohibiting appeals to make it more harder, and therefore it's a distrust element again. Well, why? What was the need behind this, except one can understand a cost constraint. So what does it all mean to the ratepayer? Well, confusion and uncertainty for the 217 revaluation. I'm afraid to say there's no guidance yet on exactly what information you'll need to provide and how at the challenge stage, but I expect that some form of statement will need to be provided with proviso that it's truthful, accurate, and potentially subject to a fine if it's inaccurate or incorrect. So is that something the ratepayer wants to do, or is it something you'll need to take advice on? No guidance yet is given on what exactly is meant by an alternative rating list entry, whether it's a single rateable value or a complete alternative summary valuation. And again, what's the reasonable test here? Agents will probably have a higher standard, the unrepresented probably a lower standard. But no guidance is given on the negotiations, but expected to be pretty much the same as the current system. Things like the ratepayer will see tailored information. Well, what is tailored information from the VAA about his rateable value? So we don't know what this is. And finally, really, the onus is very much on the ratepayer to provide a meaningful and what I would really say, complete information to help the VO reach a view. Well, with respect, the VO should have that view. Where we're doing and what we're challenging really is where we think is wrong. And so, not surprisingly, he may not find what we're saying as being particularly meaningful in the first instance. So, what's happened to fairness and equity with this taxation? It's no longer free now to appeal in the current system from 217. You've got to pay for it, which is obviously going to make the ratepayer think twice about putting his hand in his pocket for something that may be speculative. And it's only going to be refunded if successful. But what is the definition of success? Supposing actually you win at BT, but then it goes to the upper chamber, lands tribunal. There are all sorts of things that are still yet to be clarified. So, really at the end of the day, I'm afraid to say, I started off by saying, this is a confusing tax, and I don't think the government's done much to help to really alleviate that, I'm afraid. So let's conclude now, really, and I'm sorry that I've overrun a bit here on the time, if you've got questions, but given the small number of people here today, hopefully I can sort of be a bit forbeared on this. Let's look at the key information, milestones and dates, because this is really what you need to be aware of. And again, I'm not dwelling on antecedent valuation dates, but effectively that is the date, 1st of April 2015, when all the rents have been assembled by the Valuation Office Agency, and they are setting the rateable values based upon those rents at this antecedent date of the 1st of April 2015, and they will be used to value your premises rateable value-wise from the 1st of April 17. Again, the system for doing that isn't for today's lecture, but there are very good reasons why that happens. It's to do with uniformity of assessment. Now, effectively, I want to then jump really now to the 31st of March 2016. We've just gone, and the Valuation Office Agency now has said we've got certain limiting dates on appeals, and effectively now any appeals against the 210 effectively now are only applicable and can be backdated to the 1st of April 2016. Moving to this date here, 30th September 2016, this is an important date. This is when the Valuation Office Agency will publish all the new rateable values for the 1st of April 2017 revaluation. All the new rateable values are published as a draft list, and you'll be able to go online and look at this, and so will we. Hopefully we'll be having access to that data. That will then, of course, a lot of people are starting to see big increases in London, which we can discuss perhaps in the forum shortly. And we're going to see changes to the rates in this time period as well. So from the 30th of September onwards, after the summer recess, to next April, I think we're going to see lots of further information changes. So watch out for regular updates. Then really in February 2017, the draft will effectively now create the new rate bills unless they've been changed effectively, and they will be sent out, and the compiled list will go live from the 1st of April 2017. Your new demands will be there on the mat, and I imagine lots of people will be picking up the phone and saying, what on earth is going on here? Because there's going to be lots and lots of changes. So let's have a quick checklist summary of how to prepare as I conclude. The new valuation date, as I've said, for the next revaluation is based on the 1st of April, okay, rents, okay, open market rental values, subject to some certain amendments. There's a new regime coming in from the 1st of April 2017 of check, challenge, appeal, simply against your rates appeal system. Key revaluation details are still to be confirmed. The multiplier, the duration of the list is assumed to be 5 years, but we're not sure. Maybe there's a consultation paper out at the moment, maybe making it shorter periods. And of course the big thing for London, the transitional arrangements, because the rental values are going to increase, and transitional arrangements I think will have to be implemented on certain areas. And the important thing that we haven't really discussed, but this is coming down the line, is the devolution. The billing authorities set their own NMDR from 2020. So these are big changes that's going to affect the way the rates will change. So how to prepare? You need to employ professional rating advisors. I'm afraid to say, I'm sorry, but I think that's the only way forward with what's coming down the line. You can review your draft list in I said October, but effectively from the 1st 30th of September it's live. You need to verify your facts of occupation. Oh, there's tenants in there, I've seen, and basically in rents that are crucial to the challenge stage. I mean, you need to identify evidence, and that's where you're going to have help. And I think really what you've got to do finally is review any past and present future saving opportunities that you can, whilst you still can. And on the right are a selection of little pointers that you should consider. So in essence, that's me done. And I'm sorry I've overrun, but effectively it's quite a lot to charge through here, and I'm very happy to take any questions.
Simon, a huge thank you. That was a tour de force, huge amounts of ground covered, and clearly an awful lot in the pipeline for businesses to grapple with in the months and indeed years ahead.